I'm Rajeev. I'm a managing partner at Orios Venture Partners, an early stage fund with about 1,000 crores in deployed in 75 plus startups. We have created 3 unicorns, the last of which came out the last year, farm easy. So quite excited to be in the space. I'm here to welcome you all, to this event. Very excited to be putting together this session with Eric in a year where all of us have been forced to learn a lot of new lessons in economics and in hygiene and in, disease management and prevention. Unfortunately, India is still, sort of going through the learning curve on that at this point in time. Coming back to Eric, though, Eric is the rare new breed of investor, analyst, strategist who is able to simplify the very complex, demystify the mysteries of the economy. He makes things easy to understand. That I think is the big thing about him, which I love listening to. I mean, Eric, you're my favorite hearing podcast thing when I'm walking, when I'm running.
That's so nice to hear.
Thank you.
Thank you.
So Eric looks through this framework and articulates, based on his framework, what the future portends for America, right? And since America is the world's largest economy, the reserve currency of the world, and the world's innovation engine since the World War II, this is in effect a prediction for the world, right? What this means for you and me is the following. Based on this framework that he has created, we can analyze the information, come to some conclusions, and allow us to pick and choose and take decisions. That's really what this means. That's a big ask for today, particularly because governments across the world, in responding to the pandemic, created a lot of money printing and distorted market signals, right? So, that essentially created a haze over what the actual economy is up to. So Eric is that infrared X-ray that allows us to penetrate that haze and see clearly what's happening and make choices based on what is happening. Eric's celebrity status has been cemented by his remarkably prescient predictions in the last 1 year, which has multiplied returns on his own portfolio and the portfolio of those he advises. So what I'm going to do is to hand over to him for about 45 minutes for his analysis of today's state of play and tell us where we should be looking. After this, we'll move to the Q&A discussion, picking from the questions that you folks in the audience have already suggested and perhaps new ones raised, which I'll request Eric to comment on. Look forward to a productive 1 hour, an hour and a quarter at the most. And, Eric, over to you.
Thank you very much. I'm just going to share my screen now to get to some of the slides that I have. Can you see this okay?
Absolutely. And you're loud and clear as well.
Okay, great. So thank you very much for inviting me to share my thoughts on the global economy. I just want to first wish everyone well. Hope everyone's doing safe from the pandemic. Since some of the listeners on this call may be new to the work and the research that I provide, I just want to start with a quick overview of how I approach the world or how I approach any economy when looking to determine my outlook. My work is mainly focused on the United States and then other major areas of the world like Europe and Japan, but I'm planning to expand my international coverage to more regions. At any given time, I always hold 2 viewpoints about the economy and how it translates to asset allocation. I always have a long-term or secular view on the economy, and then I also have a shorter-term or cyclical view on the economy. As far as the secular trend, what we're trying to identify is what I call the gravitational force in the economy. So we look at very long-term, slow-moving variables like demographics, productivity, debt, and we formulate a conclusion about what the next 3 to 5 years is most likely to look like. The cyclical trend is also very important and can sometimes move in the opposite direction as the secular trend. So when analyzing an economy's cyclical trend, we're looking at the most sensitive industries like manufacturing or real estate and housing to get a sense of what the next 3 to 6 months will look like. So the cyclical trend should not be confused with the very short term, like a daily or weekly price movement of the S&P 500. We're really trying to look at what the next 3 to 6 months will look like. And with the secular trend, we're looking at 3 to 5 years. Anything shorter than a couple of months is for more active traders, I would say, but not as relevant for the people that like to use economics. Just a couple other points before I move on. With all these trends, I'm mainly concerned with the direction of the growth rate. So if growth is 2% and then it increases to 3%, that would be a positive trend. But if growth is 4% and it slows to 3%, that would be a negative trend. Even though in both examples we end up with 3%, it depends on the trend and the momentum of the economy. So at any point, we have a long-term secular view, a shorter-term cyclical view, and in the next couple of slides, we'll take a look at some of these trends for the United States, Europe, Japan, and I also included India as well. So right now, the US and global economy are facing negative long-term secular trends, but positive short-term cyclical trends. So that means over the next few years, global economic growth is likely to continue falling, while over the next 3 to 6 months, we're still likely to show very strong upward momentum in the global economy, especially as economies around the world gradually reopen. So I always start my presentations with a chart of nominal GDP for the United States. This chart tends to surprise a lot of people. Nominal GDP growth is growth and inflation. And this chart shows a long-term 20-year annualized growth rate for the US economy. So the way that this chart reads is that over the last 20-year period, the United States has experienced nominal GDP growth of only 3% per capita. That's including inflation. The decline in the long-term real GDP per capita is also extremely pronounced. Real economic growth, so that's excluding inflation, over the last 20 years has been just 1.3% per capita in the United States, down from well over 2.5% in the 1960s and 70s. So the US has lost almost 50% of its trend rate of growth over the last several decades. We'll get into why. It's not only the United States that's showing a long-term trend of declining nominal GDP growth. Most of the developed economies are showing declining secular economic growth trends as well. Europe and Japan in particular have seen much sharper deteriorations in nominal growth compared to the United States. China is also showing declining growth, but I kept them out of this conversation because I feel that their data is not comparable and it requires its own separate discussion. But with that said, China is also showing a declining secular trend. So the countries that comprise the bulk of global GDP are all slowing in terms of nominal GDP. Same chart, if I include India, on the other hand, it's showing a strong secular growth trend. Again, this is nominal growth, and this is a long-term 20-year growth rate. So there are two things to note. First is that India's growth rate is clearly much higher than everybody else, 8% compared to 3% or 0. But also, from the earlier slides, the direction is also trending higher, or at least it's been stable for the past 10 years. So those are two distinct differences. Is one, the growth rate's significantly higher, and two, the direction is different. In terms of real economic growth, so removing inflation, the trend is even sharper. Growth in the United States, Europe, Japan, and China are all faltering. If we include India, India again bucks this trend in a positive way with real growth that's much higher than the United States, Japan, and Europe, and also with a positively sloped trend. So we know that the secular or long-term trend for both nominal GDP growth and real GDP growth is slowing or declining. And this trend is consistent across the United States, Europe, Japan, as well as China. So global GDP has moved lower as well. India has demonstrated strong growth for reasons that we'll cover now, namely demographics and productivity advancements. So as I noted in the first slide, for long-term trends, we want to look at demographics and productivity. Over the last few decades, the United States has experienced a very rapid decline in the rate of population growth. After World War II, population growth surged as high as 2% on a trending basis compared to less than 0.6% today. And the results for 2020 as a result of COVID have actually been even lower. This is a trend we're seeing around the world where birth rates declined in 2020. The World War II period is very interesting. The United States had explosive growth for decades after World War II, and that was for many reasons. But a major reason was the radical shift in demographics. The United States also at that time had a very high net national savings rate. So the combination of a high net national savings rate and accelerating demographics is a very powerful cocktail that can solve many problems. And India is in the unique position to have both of these tailwinds at the moment. So the forecasts for the United States are in red in this chart, and it shows that population growth will continue to decline. And that's going to weigh on US growth in the future, which also means that that's going to weigh on global growth in the future. So as far as India is concerned, industries that are heavily reliant on growth coming from the US, Europe, Japan, and China will likely start to feel this slowdown. But there's tremendous opportunity to harvest the higher growth rates that India has to offer through more cutting edge technology and new age industries versus industries that rely more heavily on the older aging world. So the declining rate of population growth is not unique to the United States. In fact, the United States is better off demographically than Europe and Japan, which is a major reason why the US economy has been able to maintain higher growth rates than Europe and Japan. India has much higher population growth than the advanced economies, and it's likely to stay that way for at least the next few decades. Now, this is an extremely important slide, in my opinion. This is what is called the Age Dependency Ratio. So what this measures is how much of a burden is there on the prime working age population. The higher the number, the greater the drag on productivity there will likely to be as the prime age working population, those people 15 to 64, have a greater number of older and younger dependents to support. So this chart plots the current ratio in 2020 and the expected ratio a decade in the future in 2030. Japan, graphed in purple, is going to face an extremely difficult decade ahead as the dependency ratio is getting worse, and it's already at pretty extreme levels. Japan had a very difficult decade over the last 10 years, and it's likely to be even more difficult as their demographic situation has deteriorated even further. The United States, Europe, and the United Kingdom are all basically in the same trend, facing declining population growth and worsening dependency ratios, which is going to further drag on potential growth in the future as most of the developed world, most of the countries that make up the bulk of global GDP are going to continue to support larger number of dependents. India, on the other hand, is much better off with a lower dependency ratio than most other countries, and it's also going to be declining over the next 30 years, which is quite unique in the era of aging populations across the world. So that's a very unique position. So we know the demographic trends and that there's going to be a lot of headwinds for the United States and the global economy in terms of potential growth. So we have to look at demographics, and we also have to look at productivity. That's the second part to the long-term secular trends. And we can proxy productivity growth by how much growth an economy is generating per $1 of debt. Everyone knows in the United States and most of the developed economies are debt-based economies. So ideally, an economy generates at least $1 of growth per dollar of debt. If you think about it, if you take out $1 of debt and it generates less than $1 of growth, that's not a very good use of debt. So what this chart shows is the semi-annual change in growth and the semi-annual change in debt, or in other words, how much growth is the United States generating per dollar of debt that we are using. And the black line is a smoothed average. And what this shows is that the United States used to generate almost a full dollar of growth per dollar of debt in the 1950s, 60s, and 70s. But as we've started to use debt more unproductively, which we can get into, the effectiveness of our debt has dropped dramatically down to just 30 cents per dollar of debt. Now, this chart shows the same thing. It's just graphed slightly differently. And basically what this is showing is that the amount of economic growth that we are generating in the United States per dollar of debt is falling, which is another way of saying that our productivity growth is falling. So in the United States and most of the developed world, population growth is falling, dependency ratios are rising, and that's leading to a major decline in the efficacy of debt. So the combination of these factors paints a very clear picture for worse growth in the developed world in the decade to come. This chart here breaks the US debt situation down into its main components. We have household debt, business debt, government debt, and the summation of all three in the bottom right, which is total domestic non-financial debt. And all of these categories are measured as a percentage of GDP. It's the way to standardize it across sectors and different economies of the world. The red line are thresholds for debt to GDP for each sector. And these thresholds come from a research paper published by the Bank of International Settlements titled The Real Effects of Debt. Now, these thresholds have been replicated many times for dozens of economies. So they're quite helpful in assessing a country's.
Eric, I think you're going on mute.
Yeah, where did I leave off? Where was the last part that you heard?
Country.
Okay, so the thresholds for each sector, is just the red line, comes from a paper, Bank of International Settlements. And these thresholds have been replicated many times across dozens of economies. So they're very helpful in assessing a country's debt situation. In the United States, as you can see, we're bumping up against, we're either right up against the threshold or way beyond the threshold for all major sectors of our economy, which means that if we try and increase debt more, which we are, we're going to have negative results rather than positive results. These thresholds indicate that when debt to GDP moves beyond that level, the impact of the debt starts to have a negative impact versus a positive impact. So particularly in the United States, the government sector is way beyond what we would call the diminishing marginal returns threshold. So increases in debt in any sector are likely to have negative results, but the worst results are likely to come from further increases in government debt, and that is precisely what we are doing at this time. So India has another benefit in general compared to the other major economies, is that it's relatively lightly indebted. Household debt is quite low, as is business debt. The only red or yellow flag that I would say is government debt is getting to, it has slightly surpassed what we would call the diminishing marginal returns threshold. I'm sure that's probably in part related to government response to the pandemic situation. But in total, India has debt to GDP of about 150% as of a recent report from the IIF Global Debt Monitor. And that's a very healthy ratio for the most part. So good demographics and low debt or high savings is the best recipe for an economy. India should be mindful of the government debt, but otherwise the long-term outlook is quite bright for India relative to the United States, China, Japan, and Europe. So if you take the sum of expected population growth and the marginal revenue product of debt, which is the slides that we had before, how much growth is an economy generating per dollar of debt? So if you take those two factors together and you add them up, you get a rough approximation of the economy's trend rate of growth. In the United States, our trend rate of growth over the last 20 years in real terms was about 1.3%. Based on this formula, over the next 10 years, we're likely to have real per capita GDP growth that falls below 1%. And if we extrapolate these trends into the future, we're likely to lose another 14% of our trend growth because we're going to have declining population and we're going to continue to increase debt, particularly in the wrong sectors. So this same exercise can be done for Europe and Japan. And these two countries show an even more dire situation, as all three economies of the world are going to struggle to grow more than 1% per capita in real terms. So from a long-term secular view, the United States, Japan, Europe, and China are going to slow in terms of real economic growth. This means that global growth is going to decline as well, and India is much better off demographically and has lower levels of debt. So as I noted before, industries that are heavily reliant on the United States or the developed world for the growth that they get will certainly feel this slowdown. But industries that are more focused on technology or new age industries are likely to continue to perform very, very well compared to industries that are highly sensitive to U.S. economic growth. So that's the long-term view for the major economies of the world. Now we're going to look at the cyclical view, or the next 3 to 6 months, and see if the economy still has momentum or if the economy is going to start to slow down after this initial rebound that we've seen from the pandemic. This section will be a little bit more focused on the United States, but these trends are all quite similar around the world in terms of the impact that COVID-19 had on some consumer and economic trends. So what happened during the pandemic, particularly at the beginning, was that everybody was locked at home and we were not able to consume services like restaurants, movie theaters, Broadway theaters. So there was a major shift in consumption behavior from consumption of services to consumption of durable goods, which you're able to consume at home. Everybody had to stay home, so people bought new desks to work at home, new chairs, new computers, new TVs, new appliances for their homes to make their situation more comfortable. All of those durable goods require a manufacturing process and raw materials, whereas services require significantly less manufacturing and raw materials. So what this chart shows is the ratio of durable goods consumption to services consumption. When this line is moving lower, services consumption is rising faster than durable goods. And this line has been in a long-term downtrend because the US economy has been moving more and more towards a services economy. Right at the end of this chart on the right-hand side, you could see the spike higher, meaning that durable goods consumption started to increase way faster than services consumption. This is the same chart just zoomed in over the last 10 years, and you could really see how sudden and sharp the shift in consumption was. Now, this happened basically globally, and no one going into 2020, no manufacturer, no supplier was prepared for such a dramatic shift. Nobody kept that much inventory. So if we were to look at this in another way, this is the chart of total durable goods consumption in the United States. So we're very clearly way above the trend line in terms of how much durable goods the United States typically consumes. So as I mentioned, this happened in basically all countries, all at the same time. So what ended up happening is that we depleted the inventories of all manufactured goods around the world. This chart shows inventories as a percentage of GDP. So we're still at record lows in terms of inventories. So what happens when everybody shifts all at once to durable goods and there's no more inventory is you need to place new orders to fulfill all of that new inventory. So this chart here shows what we call the new orders to inventory ratio. This comes from a report called the ISM Manufacturing Report. And what we can see is a huge boom in the ratio of new orders to inventory, meaning that new orders are piling in way faster than existing inventory can handle. And thus manufacturers around the world have to produce a lot more goods to fulfill the incoming new orders. When everyone is trying to place new orders and manufacture goods at the exact same time, what ended up happening was we saw a boom in commodity prices or raw material prices because everyone's trying to produce all the same goods at the exact same time. The boom in commodity prices has been exacerbated or made worse by the fact that supply chains around the world are not functioning optimally. So one trend that happened because of COVID was that everyone shifted to durable goods consumption at the same time that inventories fell and new orders rose. And this created a large demand for raw materials and commodities at a time when supply chains were very stressed. And this caused a still ongoing surge in commodity prices. So COVID created a manufacturing boom around the world. And due to these secular trends that we discussed at the beginning of the presentation, this boom will not last forever. The US and the global economy will start to slow again, and they will start to converge to that long-term trend. Not right now, however. The other major trend caused by COVID, at least in the United States, was a major shift. Millions of people from living in cities like New York City to suburb living. So everyone left apartments and bought new houses. So this chart shows residential fixed investment, which is a category of our GDP. And essentially what this measures is the housing and construction sector, how much activity is going on. And we can clearly see a major boom in housing activity because everyone left the cities and bought new houses. So if you have a manufacturing boom, at the same time that you have a housing boom, you're going to get very strong growth. That's not a surprise. But these are cyclical sectors. They move in cycles, so they will cycle down again. And we have to monitor what we call the cyclical indicators. We monitor these on a monthly basis to make our determination about the next few months. If you remember from the first slide, the cyclical view is a view of what we think the economy is likely to look like over the next 3 to 6 months. So this chart here shows what are some cyclical leading indicators of the manufacturing, durable goods, and housing sectors. I'm not going to go into every single indicator specifically, but generally, when these indicators are trending higher, the risk of a cyclical downturn is very low. And when these indicators are trending lower, the economy is cycling lower and the recession risk is rising. So clearly right now, the cyclical indicators are trending higher, which means the economy should be on strong footing over the next couple of months. Any single indicator can fail at a turning point or an inflection point. And that's why I use what I call a basket approach, or looking at many economic data points that are all from different reports, different sources, different sectors, because the collective of all the data points are unlikely to miss major turning points. These aren't the only cyclical data points that we look at, but this is my top level dashboard that I can refresh at any moment and get a quick idea of where the cyclical trends in the economy are headed over the next few months. So when the US or the global economy is trending higher, which it is right now, what we call risk assets perform very well. This means that generally commodities and stocks whether you're in international markets or in the United States market, are likely to offer stronger returns than safe assets like bonds or stores of wealth like gold. This also means that generally any investment that has a higher risk profile, startups, things like this all tend to perform better when the global economy is accelerating. When growth is rising, profits should be rising, and that's a positive for risk assets or equity, public or private. This chart shows the performance of commodities relative to stocks, gold, and bonds. And since the trend is rising, this means that commodities have been the best performing asset. This makes sense given the trends that we talked about. But if I expand this to cover a few more sectors, what we see is that stocks and commodities are the two best performing assets relative to bonds and gold. This isn't always the case. In 2018 and 2019, the global economy had a pretty sharp slowdown. Some economies actually went into recession, and bonds performed very well. Because when the economy is trending lower, you get paid to be holding safe assets. When the economy is trending higher, you generally get paid to take on more risk. So I would love to take any questions that you have. I just want to summarize some key points. And the US and global economy are going to experience declining rates of growth because of worsening demographics and high levels of debt. India does not have these secular problems. Industries in India that are very correlated to the US or Europe or Japan will start to feel the impact of these major economies slowing down, but there's so much room for high growth in new age industries in the adoption of technology. While the long-term secular trends for the economy are lower, and we should be concerned about that, cyclically, the US and global economy are still in the middle of a very unusual boom due to trend changes as a result of COVID. A manufacturing boom and a housing boom has created a lot of demand for goods, and it's become hard to source those materials around the world, with every country dealing with different situations in terms of lockdowns and supply chains. So to spot the next inflection point when things are going to start to turn, we have to keep watching those cyclical indicators for our 3 to 6 month view. Right now, the risk of a new downturn over the next couple of months is quite low. When the US and global economy are accelerating, like now, commodities, stocks, public and private equities, anything that has a little bit more risk generally performs far better than safe assets like bonds or gold. International markets, emerging markets also tend to perform much better during periods of accelerations in the global economy. Personally, I hold portfolios that are balanced between stocks, bonds, commodities, and gold. And what I do is I shift my allocation to whatever assets are likely to perform the best given these trends. So currently, I hold overweight positions in stocks and commodities and underweight positions in bonds and gold due to these cyclical trends. I plan to move and flip back to a heavy overweight position in safer bonds when the leading indicators signal the risk of a new downturn or the risk of recession is rising. Thank you very much for listening. I'm happy to take any questions that you have. I have an appendix of dozens and dozens of slides. So if there's a question that applies to any of those, I'll be able to refer to a new slide.
Super, Eric. I think that was a very erudite, and a very clear, concise presentation. I just love listening to it. This is the third or fourth time I'm listening to it because I keep hearing you out, but it's still extremely elucidating whenever I hear it. Let me start off with a question that I think is, quite a few of our investors have asked. One is really, this entire notion of money printing and how that is leading to inflation. You've spoken about how the demand post-COVID has led to inflation, but I think if you could sort of talk through the quantitative easing, how that sort of works, what is this money printing about, and how does that lead to inflation, or is there an inflation risk at all? If you could sort of expound a bit more on that.
Absolutely. So I will try and break down my views as succinctly as possible. So in my personal opinion, the concept of money printing is not exactly accurate. Money printing to me has a very specific definition. We are doing what we call quantitative easing, and it can increase the money supply. I do have a chart here. So this is the US money supply. The money supply has exploded, which has caused a lot of concerns of inflation. The counter to the money supply is the velocity of money. So the money supply is how much money is there in circulation. The velocity of money is how much growth are you generating for every dollar of debt or every dollar of money in the system. And as you can see, this is coming down quite significantly. It's been coming down since the 90s, but COVID, when we decided to increase the money supply went up, the velocity went down, and it was an offsetting factor. So there was no inflation that was caused because of the money supply. All the inflation that we are seeing is based on commodity prices because of the squeeze in materials. So what happens when the government does quantitative easing is the Federal Reserve buys a bond from the private sector, and the institution that gave up that bond now has a deposit or now has cash. That's why the money supply goes up. But the banks that passed that bond to the government now have what we call a reserve. Reserves are not included in the money supply. And what we see is that all of this new money that has been entered into the economy has not gone to generate new GDP growth. Otherwise, the velocity of money would be increasing. So all of this money that we are printing, for lack of a better word, is not going towards the economy. What happens is it stays trapped in financial assets like stocks and real estate, and it can cause the price of assets to rise, but it's had no measurable impact on the economy at all. This chart here shows what we call the loan to deposit ratio. So as the Federal Reserve is engaging in quantitative easing, deposits in the banking system are rising. Now, standard economic theory would tell you that if deposits are rising, banks can make more loans. And the more loans the bank makes, the more money gets into the economy. And that's how quantitative easing is supposed to boost the economy. But that's not what's happening. What we're seeing is that the amount of loans that banks are making is not keeping up with the amount of deposits that we are putting into the banking system. So we're putting all of these deposits into the banking system. The banks are taking that money and just holding it, and they're investing it in mainly financial assets. They're not investing it into any new loans that go to productive growth. So all of these activities are not productive at best or counterproductive to the real economy. And what we're seeing is basically money that's being used quite ineffectively. If it was being used more effectively, we would see velocity and GDP start to increase. But despite what is about $7 trillion of quantitative easing, if I go back to one of the first slides, we've done trillions of dollars of quantitative easing, and the result has been no growth, and this is nominal, so no inflation either. So the quantitative easing and the increases in the money supply are not directly going to cause inflation or economic growth. The inflation that we're seeing now is mostly a result of commodity prices, in my view.
Great. Of course, they have caused the asset price inflation, which I think we have seen because of all that money flowing into the asset side of the equation, not in the real economy.
They basically take the newfound money and they don't want to give it to new loans because, like we showed here on this slide, in the United States, every sector of the economy is extremely indebted. So from a bank's perspective, you would not want to give loans to a very indebted household sector or a very indebted business sector. You'd much rather make loans to a hedge fund that are going to invest in more financial assets. So that's what we're seeing in the United States, which is the more quantitative easing we do, the more it impacts asset prices, and it's having no impact at all on the real economy.
Great. I'm going to now switch gears to ask you one thing that I saw you explain very well in one of the different videos, which is essentially going back in history and looking at the post-World War II economy, which is when the United States took over as the innovator of the world. And I'm going to sort of lean on your own argument. Basically, GDP is a function of technology interacting with land, labor, and capital. That's really what I think you said. And it was that technology innovation that sort of pushed US into a completely different trajectory that started, I think, post-World War, but it has continued for almost until, the turn of the century. Can you sort of explain that story a little bit more, Eric? So I think we in India believe that technology revolution or innovation is something that we could sort of benefit from. So that would be very helpful for us to know.
Absolutely. So as I mentioned in the earlier slides, a few things happened in the United States. The United States had had some debt to get through the war, but this boom in demographics was, you could call it a once in a lifetime or a once in a century boom in demographics. And if you take population growth from 0.6% to 2.2%, you're going to get a lot stronger growth. So that was extremely important. To get out of the war, and it was extremely important to get out of the depression, and extremely important for growth in the years ahead. And population growth stayed at quite an elevated rate for the next 20, 30 years. India does have very positive demographics, so the situation there can be similar. The second thing that happened, and I have a slide here, is that this is what's called the net national savings rate. Excuse me. A lot of people look at just the personal savings rate, but really what you need is national savings. So national savings is the summation of household savings, government savings, and business savings. Right now, in the United States, we have very high personal savings because we handed everybody a lot of money and they didn't spend it. So personal savings is upwards of 20%. But all of that savings came from government dissavings or government spending. So the two have offset each other, and businesses aren't saving either. So as a country, we have a very low net national savings rate. That's not a good thing. During the war, World War II, we had over 15% net national savings, which allowed us to pay down a lot of debt, and it allowed us to have a new clean balance sheet. And as I mentioned in the slides on debt, India is in a similar situation where the national savings rate tends to be quite high. There's low levels of debt in the household and business sector. So that's a very positive sign. The third thing that happened during World War II was the fostering of innovation that could not happen during peacetime. The COVID situation could be similar in the sense that a lot of new technology had to be created to work from home, and all of those things may contribute positively. So for the United States, after the World War II situation, there were three major factors that contributed to very explosive growth in the years ahead, which was very positive demographics, very high net national savings, and a increase in technological innovation. And when we look at those three factors, India certainly has one of the strongest demographics. It has higher levels of savings or low levels of debt in most of the key sectors. And there's still a lot of room to adopt new technology. So India is well positioned to stage years ahead that look similar to the United States in that regard. What India would have to guard against as it becomes a more developed economy like the United States is these ratios going in the other direction, where now the United States is at the point where actually during COVID, we have negative net national savings, which is a very bad thing for growth. With no savings, you could have no investment. And with no investment, you could have no future productivity. With very high levels of savings, you could have high levels of investment and therefore high levels of productivity. So that's the World War II situation in a nutshell.
Thank you so much. Folks, by the way, a message for those of you in the audience that are so excitedly listening. Please submit your questions if you have any through the chat box. We will try and reach them as much as possible with Eric. That's a query here. Eric, the other question that I think has come up also is, in agricultural commodities. So, you and I were speaking about how lumber prices in the US have gone up 4 or 5-fold, and because of which, home building has become a much more expensive activity there, $40,000 to $50,000 more per home than it used to be earlier. What do you think is going to be the impact on, agricultural commodities, particularly given, wheat, rice, other health, these kinds of, environments, also given the green, environment that's happening at this point in time?
So my view on commodity prices is more all encompassing. I don't have views on specific commodities, but generally, the growth rate in the commodity prices or the rise in commodity prices will be tied to global economic growth or global economic demand. And since the global economy is going to experience declining rates of growth, in the United States, we have declining rates of growth. Generally, what we'll see is we should see a depressing impact on commodity prices over the long term. We should see declining rates of commodity price growth. One example would be oil prices. In the United States, oil prices were over $100 a barrel in 2010, 11, and they dropped to $40 a barrel, and now it's risen again post COVID. But copper prices too. I mean, if you remove the impact from the pandemic and the supply chains from 2010 till 2019, let's say, almost all commodity prices or the most major industrial commodities have fallen in price. So in my opinion, once we get past this short-term squeeze on resources and commodities, we should see the price of these commodities start to fall over time.
Got it. Understood. One interesting asset class that sort of seems to have exploded since October, November of last year is crypto, right? Do you have a point of view on crypto, and do you think do you know where it's headed? So
I'm not a crypto expert by any means, but in my view, a lot of the enthusiasm behind cryptocurrencies is based on the notion that governments around the world are printing a lot of money and debasing their currencies. I don't hold that view that what we're doing in the United States currently is debasing the currency. The way that quantitative easing works is not what Germany did in the Weimar Republic. It's not what Zimbabwe did. It is not what Venezuela did. Those are completely different examples of actual money printing. What we're doing now is we're using a lot of debt, but for every dollar that the government spends, the government issues a dollar of debt. One of the differences would be if the government just spent money and there was no debt, but the government is borrowing the funds and then spending the money, which is a different situation. The other thing is I have some slides here on the US dollar. This is a trade-weighted US dollar against most currencies. And what we see here is that, since 2007, the United States has printed, for lack of a better word, I don't agree with that term, but most people would say the US has printed $7 trillion, but yet our currency has strengthened. So I generally believe that some of the enthusiasm of cryptocurrencies is based on a misunderstanding of some of the monetary economics. I don't believe we're printing money, so I believe that aspect of cryptocurrencies is misguided. I also think that there's a significant portion of cryptocurrencies, at least in the United States, that are being used illicitly mainly to avoid taxation. There was recently a report yesterday that came out from the DOJ and the FBI looking at ways that they can tax cryptocurrencies. So I guess my views on cryptocurrencies would be no, I don't expect them to replace the dollar or any other major currency of the world. I think that the main premise behind them, if the premise is money printing, is based on a flawed view of the monetary system. But with that said, there may be more nuances to some of these other currencies or altcoins or coins other than Bitcoin, which I'm not completely familiar with. So those are my high level views on Bitcoin.
Great. I think one more question that has emerged is basically the trade deficits that the US is running. I think a lot of the nations are looking at the United States as a partner with to create the dollar requirements in their own nations, which allows them to buy oil or other things. That's the benefit of the reserve currency as a storyline. And the US has had to sustainably or consistently run trade deficits over the last, 20, 30 years. Do you see going forward into the future, because this has started to hurt the US as well, do you see that deficit reducing in any form of fashion? And if that happens, do you see the trade balances? How do you see the trade balances between the different countries in the world go? Specifically, obviously, we are interested in India, whether we can continue to see US as our place to, export, more stuff to the US or not.
Right. So our trade balance, this is the trade balance for goods, as it's obviously gotten pretty significant. This is a monthly basis, so it's about 90 billion a month. This is going to get worse in the United States, or the trade deficit is going to get worse. And the reason we know that is because there's an accounting identity called the National Savings and Investment Identity. And what that means is that savings equals investment. So in the United States, we have very low levels of savings. In fact, we had negative savings at one point. And negative savings means you cannot have any physical investment. The caveat is if you have no savings, you can get investment if you basically import the investment. So mechanically, by running larger and larger fiscal deficits, we're going to be reducing our net national savings, which mathematically is going to require us to run even larger deficits, trade deficits, if we want to continue to support the same level of consumption. So in the US, we have a situation where the government likes to spend a lot and consumers like to consume a lot. And the only way that those two things can continue happening is if our trade deficit gets significantly larger. So I'm most familiar with the United States situation, and I would say that the trade deficit in the United States is going to get larger with most of its trading partners. And you could use this framework for other countries. So if government spending is very high and national savings is very low, your trade deficit has to be really big. So that's the situation there.
Great point. Thank you so much. One further question that has emerged from a previous answer that you gave is essentially, look, if the real GDP is not getting impacted at all by the liquidity uptick that the Fed has introduced, why is the Fed actually doing it? What is the benefit in the Fed?
That's a great question. That's a great question. There's no good answer to that question. I guess you'd have to ask the people at the Federal Reserve. You can have a couple opinions. One is that the Federal Reserve believes that quantitative easing is in fact easing. So the United States, we have 0% interest rates, and GDP is not increasing. So historically, what the central bank would do is they would lower interest rates to try and stimulate demand. The Federal Reserve has said explicitly that they do not want negative interest rates. So because they don't want negative interest rates, they're trying to do a lot of quantitative easing, thinking that will in effect, create easier conditions. And what they think happens is that when they do a lot of quantitative easing, they believe it lowers interest rates on the long end of the treasury curve. And like maybe 10, 20, 30-year treasury rates, they expect those to come down. And when those rates come down, mortgage rates come down. And when mortgage rates come down, it's supposed to stimulate housing activity. And housing and real estate is a very, very impactful sector to the economy. There's a lot of ancillary industries that, there's commodity production, there's labor, there's retail spending to furnish the house with new goods. So one of the theories is that quantitative easing will keep the long-term interest rates low, which will stimulate housing demand, and the housing demand should boost GDP. Over the last 10 years, we did not see that at all. We do have a housing boom now, but it is not for the quantitative easing effect. It's mainly that everyone just wanted to get out of the cities and move to the suburbs. So once that big shift is over, we're likely to see housing activity come down. The second thing that I would note is that the Federal Reserve has done trillions of dollars of quantitative easing since COVID started, and long-term interest rates have increased from about 1% to about 2.5% on the 30-year. You could say that maybe they would have increased more without quantitative easing, but it certainly has not worked to keep interest rates falling. Interest rates have, in fact, increased. And the reason for that, in my opinion, is that interest rates, at least in the United States, as the benchmark of the world, interest rates will predominantly move based on the cycle in the economy, irrespective of what the Federal Reserve is doing. So right now, we have a cyclical upswing. The economy around the world is gaining momentum, so people don't want to hold long-term treasury bonds. And that's what's causing the increase in yields. So even if the Federal Reserve stopped doing quantitative easing, if the economy turned down, the bond yields would come down as well. So it's a great question. Everyone in the United States is asking, why are you still doing what you're doing if it has no impact? And they don't give great answers other than what they call market functioning to basically, I guess, improve liquidity. But there seems to be quite a bit of liquidity. So it's a great question. It's something that we're all asking. No one at this point, at least in the people that I converse with, my colleagues, believe that the quantitative easing is having a measurable impact on the economy, but it does have an impact on asset prices. And I think, truthfully, they're worried about asset prices falling. So I think they're worried that if they stop, asset prices will fall, and that reverse wealth effect will hurt the economy. But they've never let that happen so far.
Great. So now one further related question from my side is really the following. Right now, the Fed and the US is not just doing the Fed related QE, right? They're also doing fiscal spending as well. So, Janet Yellen has gone on record to talk about how she's going to put in another, $5-6 trillion. I think Biden has gone on record to talk about how another $5-6 trillion of additional spending is going to be pumped in. And that's going to be paid by an increased corporate tax rate and an increased, personal income tax rate. So doesn't that also, that goes into the real economy, right? Because that's not really the quantitative easing and does not get trapped in the asset bubble per se. It goes in the real economy. As you said yourself, last year, Americans saw 25% growth in their, income because of governments coming in. I think that was a stat that you had. So how does that work? I mean, doesn't that increase inflation?
Okay, so what we see in the United States is what we call transfer payments in the United States. This could be Social Security, Medicare, Medicaid, a lot of the services that we provide to our citizens, but this also includes direct payments. So as part of COVID, we sent people a lot of checks, a lot of unemployment insurance. So what this chart shows is total income in the entire United States. That could be income that you get from wages. It could be rental income from real estate. It could be dividends from stocks. It could be small business income. all income in the entire country, if you take how much of that is coming from the government, that's what this chart is. So in the 1960s, only 5% of income was coming from the government. If you look, obviously this has been increasing. This big spike up during at the end of the chart here was basically stimulus payments that we sent people checks, and it was also unemployment insurance. So now, as of the latest figures, over 1/3 of total income is coming from the government. And that's causing a couple problems. This chart is how much of total income is coming from employment. So in the 1960s, as you would expect, 70% or almost 75% of all income was coming from basically wages. So people going to work, they earned a wage, and that's what income was. That's dropped to under 50%. So less than half the income in the entire country is coming from actual people working. So this has created a couple problems. One is that it's incentivized people not to work because so much income is coming from the government that we have a very low employment to population ratio, and we have a big problem with people who lost their job due to COVID. They don't want to come back and get new jobs because the support from the government is so intense. It makes more sense not to work. The second thing is that it hasn't contributed to an increase in the economy, and that is captured in the velocity of money. So we send people money, that money goes into their bank account. Deposits in the banking system go up, that increases the money supply. If it was inflationary and the money was being spent, GDP would rise because GDP equals money times velocity. So we're sending people money, money supply is going up, deposits in the banking system are going up, but GDP is not moving. And why is that? It's for a couple of reasons. One is people believe that people are more enthusiastic about speculating in financial assets like Bitcoin and high-flying stocks than working. So people are taking that money. You say it goes into the real economy, but then they put it back into Bitcoin, or they put it back into the stock market, which is the government sends you money. I take the money and then I buy S&P 500. That doesn't create $1 of GDP growth, but it's $1 of debt. So in that example, $1 of debt created $0 of GDP. And we've seen a lot of that. The second point is the reason it's not inflationary is there's a concept in economics called permanent income. So if I look to make a big purchase like a house or a car, generally, I don't look at what my income is today. I look at what my expectation of my income is over the next 3 to 5 years. So when we send people stimulus checks and people are under the impression that they're one-time payments or that they won't be there 5 years in the future, it actually is not creating much of a stimulation in demand for big ticket items. People say, you know what? I got a one-time payment from the government. I'm going to take this money and buy some stocks, or I'm going to take this money and buy some cryptocurrencies. It's not causing a permanent shift in people's income curves. It's just causing a one-time boost. And that one-time boost is not as effective as a permanent shift higher. And the only real way you could have a permanent shift in your income curve is if you earn more money through wages or small business or something to that effect. So that's why the fiscal stimulus has not been as inflationary as people think, and why it's not impacting GDP, because people don't want to take the money and invest it into the economy. They want to take the money and invest it into Bitcoin, or they want to take the money and invest it into the stock market. So
blame the stimulus for the Robin Hood and the Reddit gang, huh?
That's a huge. There was a statistic that I think it said 33%. So 1 out of 3 people that got a stimulus check invested it into Bitcoin. One out of three people. So, yeah.
So, last but one question really from my side. You think about what's happening in the world today. Obviously, the two big boys are at it between each other. It's America and China. And I would be remiss if I did not ask you your future prediction for what is going to happen in the context of America versus China, right? And what does that mean in terms of fallout for the rest of the world? Of course, the emerging world, which is in Asia at this point in time, India, of course. Just a thought there.
My view. I try and come at it from the least biased position possible. But in my view, the United States has a serious upper hand in the face-off with China, mainly because of the reserve currency status. So China has had one of the world's greatest increases in growth anyone's ever seen over from 1990 to 2010, those 20 years. But a lot of it was using dollar-based debt. A lot of it was used, through Hong Kong or one way or another. Their debt situation is far worse than the United States. The problem is their numbers are so opaque. It's very difficult to get a good read on exactly what's going on over there. They also have an issue of tremendous overcapacity. So China's had strong growth, but it hasn't been growth that's lasting. And what I mean by that is I'm sure everyone's heard of these ghost cities that China builds, which is they borrow a lot of money, they build a lot of buildings, and then they're empty. Building of the buildings certainly creates GDP, but the question is, once the building is built, what do you do? So I think over time, China's dominance in terms of their growth trajectory, their best days are behind them. I think that they have surpassed all levels of diminishing marginal returns in terms of their debt. And I think that previously they were operating from a position of a lot of strength in terms of how strong their impact on the global economy has been. And I think that over the next decade, their influence in terms of how strong their impact on global GDP is going to be weakening. And that's my theory as to why they have perhaps been acting more aggressively in certain areas of the world, or perhaps some of the increase in tensions with the United States is that I believe that their impact on the economy in terms of their growth trajectory is their best days are behind them. In terms of their ability to do what they did over the last 20 years will not be able to be replicated over the next 10 years. And they are operating on a quasi-dollar standard. They don't have open capital accounts. They have a pegged currency. So whether they like it or not, they're still very, very tied to the whims of the United States and the fluctuations of our currency. So I would think that China's dominance is fading. And I think that the best days for them are certainly in the rearview mirror. Their population growth, actually, they're going to have a very difficult time over the next 10, 20 years. Their population growth has actually dropped to zero. They have almost negative population growth now. And, they had the one-child policy, and they didn't want to keep a lot of their girl babies. So they actually created a situation where their demographics are quite terrible because they only allowed everyone to have one child and they didn't want the girl babies. So now they're having a very difficult time having any population growth going forward because there's such an outsized portion of males versus females. So I think China is very challenged going forward over the next 10 years. So I would think that their dominance should likely fade.
Great. As we wind down this conversation, Eric, I think, one question that I wanted to put to you was, obviously, you're talking about a short-term cyclical growth right now because all the indicators are pointing upward. But you also say that at some point in time, it'll trend towards the long-term, which is basically the deceleration that you're talking about.
Exactly.
So between now and then, and given that, the main indicators are all very hazy because of the Fed put or because the governments are interfering so much in the markets, What are the 3-4 things that you're watching that you think we should watch for us to get where that inflection is going to happen? What are those leading indicators that we would look at?
Sure. So on this chart, I have several. These are mainly for the United States, but you can perhaps find. One is commodity prices. So commodity prices will give you a great indication of how much industrial demand there is, and I track mainly industrial commodities. So things like copper scrap, lead scrap, steel, zinc. Less so the agriculture ones, but industrial commodity prices will give you a very good indication of, one, industrial demand, and two, the supply chains. The second thing to watch is the manufacturing sector. For me, I watch the manufacturing sector of the United States. If you're in another country, you can perhaps track the manufacturing sector in your home country, because the manufacturing sector globally is extremely correlated. You can't really have a US manufacturing boom with a China manufacturing slowdown. All manufacturing economies tend to move in sync. So you can track industrial commodity prices. You can track the manufacturing sector. I personally track the ratio of new orders to inventory. It's this chart here, if you can see my cursor. Mm-hmm. And basically, when that line is rising, it means that manufacturers are getting more new orders than they have inventory. That means that they have to produce more. So this would be a leading indicator of future production. So as long as this line is rising, future production should continue to increase. So industrial commodity prices, manufacturing sector. The other one that I would point out is the US dollar. The US dollar is an interesting animal because it's the world's reserve currency. I track what is called the Federal Reserve Trade Weighted Dollar Index. And I particularly track the US dollar against the basket of emerging market currencies. Now, this is graphed inverted. So that means when this line is going up, the dollar is actually falling in value. And the reason I do that is because when the dollar is falling in value, that generally means that investors are seeing opportunities in other parts of the world. They don't want to hold safe reserve dollars. They want to say, oh, look, the global economy is doing well. I'm going to move out of the United States and go into the emerging markets because I can get higher returns there, such as places like India. When the US dollar starts to strengthen very dramatically, that's typically a sign that economic activity around the world is starting to slow. People are saying, emerging markets are starting to get risky. The global economy is slowing. Let me move back into very safe US dollars. So a couple things to look for would be industrial commodity prices, the manufacturing sector, and the US dollar. I think those three factors should give you a very strong indication of what the next several months should hold. And I obviously track a significant number of these. These are some that I look at on a regular basis, but I also go beneath these layers and into more detailed ones. But if I had to highlight three that most people can track anywhere in the world that you are, I would say industrial commodity prices, manufacturing sector, and the US dollar.
Great. I think there are a couple of further questions. Do we have time to squeeze them in?
Absolutely.
Brilliant. Okay. One question is really, the dollar and commodities are generally inversely correlated. When the dollar falls, commodity prices rise. That sort of has been the situation in the past, at least. Right. This time around, the dollar index is not weakening in proportional rise in terms of commodities. So there seems to be a bit of a break in that. What do you think is causing that? That's one question that's come up.
Okay. So that's a great question. So this chart here, this one with my cursor this is a chart of industrial metals, so things like copper, relative to gold. And the reason I do that is because gold is also influenced by the US dollar, and it's also influenced by real interest rates. So if you say the dollar is going to decline by 50%, well, gold prices should rise and commodity prices should rise. So when I basically price commodities relative to gold, I'm trying to standardize for any fluctuations in the dollar, or interest rates. And what this shows is when industrial metals are rising faster than gold, which they are, that generally means that there is a ton of demand for industrial metals because the metal prices are rising above and beyond what you would expect from a decline in the dollar and a decline in real interest rates. Those declines are accounted for in the price of gold. So when the price of metals is rising faster than the price of gold, which it is now, what that generally means to me is that the demand for these industrial commodities is extremely strong, and it's rising above and beyond what you would expect from declines in the dollar or declines in interest rates. So it generally speaks to just how strong the demand is for some of these industrial commodities at this time.
Fantastic. The last question has to do with the commodities itself. So one of the things that's being spoken about is this commodity super cycle, right? And historically, these super cycles have been long, right? They've extended into long periods, right? So one question that's coming up is, how long do you expect this super cycle to last? I mean, particularly given that there is a trend line degrowth that's going to happen. Is it a cyclical uptrend that's going to go into decades, years, or is it going to be sort of suppressed in the near future?
Yeah, I don't believe that this is the beginning of a multi-year or multi-decade boom in commodity prices. I believe that this is a cyclical trend. I think that the rise in commodity prices has been far exacerbated above the normal demand, simply because of how damaged supply chains are and how difficult it has been to source some of these materials. So there's no question that the rise in commodity prices is quite alarming. However, I think that you have to discount some of the rise for supply chains, and then there truly is legitimate organic demand for these commodities. But as long as, if I go back here, as long as the United States and the global economy is on this trend, commodity prices are going to have a very, very difficult time staging sustained increases. If you think of the last time there was big inflation in the United States, real GDP growth. So in the 1970s was big inflation. Real GDP growth, which excludes inflation, was almost 3% over a 20-year period. So for 20 years straight, the United States was averaging 3% real growth. Today, we're only averaging 1%. That leads to a lot of excess capacity, a lot of underutilization of resources. And as long as both nominal growth and real growth are trending lower, it should be very difficult for commodities to stage a very long-lasting super cycle. If there's going to be less people in the world, or the growth rate's coming down, and the people are getting older, that should also set up a very difficult situation for a long-lasting commodity super cycle. So my opinion is that it's a cyclical trend. It's not ending tomorrow. It's not ending over the next month or two. COVID did cause some very significant shifts around the whole world in terms of moving from cities to suburbs and in terms of changing consumption. Over the next couple of quarters or years, as the world moves beyond the COVID pandemic and people begin to start going to restaurants again and consuming services, we should see the demand for these durable goods. No one will need another refrigerator for their house. Everyone already bought it, or everyone already moved to the suburbs and they already bought their car. They're not going to need to buy a second car. So we should see the demand for these durable goods start to fade as we move past the COVID situation. But we're still in the middle of it. The cyclical indicators are still pointing higher, which means that the economy still has momentum. If I go back to this slide here, the first slide, the cyclical trends give us a very good idea of what the next 3 to 6 months will look like. And the secular trends give us a very good idea of what the 3 to 5 year view looks like. This middle period, which is, I guess, 6 months to 18 months or 6 months to 36 months, that's a little bit foggy. And basically, we have a continual 3 to 6 month view. So if we talk again next month, the cyclical indicators will look differently, and I can give you a new update as is the economy still showing momentum? But over the next couple of months, the momentum is still higher. But no, I don't expect commodity super cycle because of trends like this.
Fantastic. So, Eric, thank you so very much for, I think, uplifted the mood of the audience. I'm coming out thinking, okay, not all is bad for India at this point in time, which I think is fantastic.
Look, that is a great trend there. That is a great trend. It's something that not a lot of other countries
That's a
have.
wonderful chart. I just love that chart. Absolutely. Right. So, I think that's one good thing, thank you so much for this. If people want to reach out to you, how would they do that? I think you're present on the social media. If you could sort of.
Sure. So I have a few different places you can find me. You could go to my website, which is epbmacroresearch.com. You can find me on Twitter at EPB Research. I have some YouTube videos if you search EPB Macro Research on YouTube. And I also publish some material on Seeking Alpha. And if you go to my website, epbmacroresearch.com, there's a contact me section. If you'd like this slide deck, if you want me to email it to you, I'm more than happy to do that. Just go to my website, go to the contact section and just say, hey, I love that slide deck. And I'm more than happy to send it.
Super. Thank you so much, Eric. Thank you so much, folks, for having been patient and having listened. I just love the story. And I think, we'll continue to hear more from you, Eric. I would love to have you back on again at some point in time in the future as well. Thank you so much. Look forward to the, further sessions.
Thank you very much. I appreciate it.
Brilliant. Thank you so much, everyone. I appreciate you coming and joining us. And thank you, Eric.
Thank you.
Can't thank you enough. Bye-bye. Cheers.